Hey, it's the Profit Answer Man, Rocky Lalvani. If you're new to the podcast, check out my interview with Mike Michalowicz. It's episode number 2. If you want to hear about each chapter in the Profit First book, go back and listen to episodes 3 through 13. Episode 1 is the why and how. On the Profit Answer Man, we learn money mastery without all the complicated accounting mumbo-jumbo using a simple system. Your accountant is busy documenting your transactions and creating a rearview mirror of what happened. My guess is you don't even look at the reports they sent you. If you're like most business owners, you struggle with this, and it's not your fault. We aren't taught money in school, and accountants aren't taught how to be profitable. The Profit First system created by Mike Michalowicz works, and he certified me to help you implement the system in your business. Remember, the new equation is sales minus profit equals expenses. Let's face it, without cash flow, you can't pay your employees, buy needed materials, or pay your mortgage and support your family. I help you to do that and more, so you can focus on the parts of the business you love and receive the rewards for your labor and investment into your business. The stronger you are as a business owner, the more jobs you create, the better we are as a country. Small business owners are the backbone of America, and for that, you deserve to be well rewarded. Just remember, more revenue does not equal more profit. That's why we focus on the bottom line. This episode of the Profit Answer Man podcast is brought to you by SMBpodcastnetwork.com. The network is a collection of podcasts and shows from around the internet which focus on bringing you interviews with amazing guests who share actionable advice, ideas, and information for small and medium-sized business owners and entrepreneurs. Visit www.smbpodcastnetwork.com to find more great shows and easily subscribe to be notified of new episodes. It's a great way to discover quality content. If you've discovered us via the network, then I hope you enjoy today's show and will consider subscribing directly so you never miss our episodes. We have a saying, don't spend $1 to save 30 cents on taxes. And if you truly feel the need, send me the $1 and I'll let you save the 30 cents on taxes. Tax planning is very important and it's an often underlooked part of your running your business. Everything from the entity you use to the tax credits you can claim. COVID's added many extra programs to what's already out there for tax savings. I'm often shocked when business owners don't realize they have the opportunity to save a bunch of money on taxes by having a few conversations and making a few small changes and taking advantage of all of the different tax credits and programs that are out there. Our guest is Tindall. She's a CPA specializing in advanced tax reduction who proactively works with clients to reduce what they pay in taxes while supporting their greater wealth building and life goals. Her goal is for every client is to provide a return on investment in the first year, usually $15,000 to $100,000 in tax savings. Let's meet Catherine and see how she does it. Welcome to the Profit Answer Man, Catherine Tindall. It's great to have you join us today.
Thanks for having me, Rocky. It's an absolute pleasure.
Can you share a little bit about yourself and your business?
Sure. So as you can probably see from the title, I'm a certified public accountant. My name's Catherine. I'm with a firm that I founded a couple of years ago called Dominion Enterprise Services, and we're a specialty CPA firm. We have kind of two sides of the business. One side is advanced tax reduction work that we do for closely held businesses. And then the other side of the practice is specialty tax credit work for things like the research and development tax credit, and then some different COVID tax credits that are out there still.
And with COVID, there's a whole bunch of new opportunity that people may not be aware of. So it's a good idea to stay on top of that, not to mention the forgiveness that was going on. I think most people have probably seen their money already forgiven, but if you haven't taken care of that stuff, you definitely need to.
Yes. And I think the big thing that we've been seeing with a lot of the COVID aid that happened is people took advantage of a lot of the programs that were highly publicized, like the PPP. But for a lot of people, there are other provisions that are, if not as powerful, more powerful, that many didn't take advantage of. So a common one that we've been working on is called the Employee Retention Credit. It's up to $26,000 per employee, and it covers tax years 2020 and 2021, but it's still going to be available to go retroactively back and collect them up until April 2023. So that's one well worth considering if you've got some employees, because like I said, 26 grand per employee, that can add up pretty quickly with a good headcount company.
That it can. And we'll chat a little bit about that. Before we do, you share Profit First with a lot of your clients. How is that helpful for them? What causes you to share that book with them?
Yeah, I think for me as a tax practitioner, and especially because my primary practice focus is really helping people reduce their taxes. Very often the first conversations that I have with them when I'm looking through their profit and loss information, the first place I see is, have you really optimized your bottom line to get the most profit out of your company? And have you really done the thought work that's necessary there to make sure that the model that you're running is as high margin as possible, right? Because if I'm trying to reduce how much tax you're paying, I really want to use the biggest profit numbers to implement those tax techniques with. So it's a very popular program that I usually recommend people who are just getting started or they're kind of early on to really take the time to read through it and work on it, because it can be so profoundly powerful. And then I think also it really lets people know if what they're doing as a business is really viable, which is something that a lot of people, they go into business with a dream or they think they've got this great idea. But then when you really look at the numbers of the thing, it's not a viable business. So I think it's a really wonderful tool and I recommend it pretty frequently.
That's when they come to me. There's like, I've been in this business for years. We've got millions in revenue. Why don't I have any money? Exactly. Because you spent it all.
Yep. And that's the first piece of it, right? It's like you want to you optimize that top line, you optimize your expenses, and then after that, you optimize for taxes. It's a pretty simple formula how you get the most net cash flow out of an operation. But a lot of people just they aren't deliberate enough with taking those three steps.
And I know we're here today to talk about tax planning, and it's something that I find very important. And I know it's something that you can't do on April 15th, right? It's yes. A little late at that point. What can you do to lower my taxes now? Well, this is a conversation that happens early and often. And I'm an enrolled agent, so I do taxes occasionally, but I hate doing them. I rather let the CPA handle it. But I know enough to say, hey, these are the conversations you need to have. So let's just kind of talk about that. What does tax planning look like? And when do you do it?
Yeah, I would say most people think they get tax planning from their current practitioner, and they really don't. So the way I like to think about it is when you go to get tax returns done at the end of the year, that's really the reconciliation of what you did during the year, right? And that's kind of tying things up and crossing all the T's and dotting the I's to the IRS to let them know what happened. And so if you're just waiting to the end of the year to start doing maneuvers and doing things, you're really not going to get the advantage of tax planning, because how you actually reduce your taxes, most of the big picture things there, you have to change how you're behaving, because the tax code is really based on how are you behaving, right? How is your entity organized? How are you paying yourself? What are you paying for? What are you, doing that's a business purpose that you can deduct? What are tax credit programs you can participate in? And those are all things that happen during the year. So if you're not pursuing those kinds of things with your tax practitioner, say April 15th to talk about this, year that's going to come up, and then talking to them in June, and then talking to them again in November to get any last minute moves in, you're really not taking advantage of what that professional is really able to do. You're really only getting the form filling capability, which is not that's not their most valuable thing that they can offer to you. So that's why I recommend people have, a more proactive relationship with their tax practitioner.
Do most CPAs do tax planning, or is it a subset? Do some just do filling out the forms?
Yeah, a lot of tax professionals just do the filling out of the forms. A lot of CPAs, it just depends. For some of them, they're not salespeople. So if you go to them and say, hey, I want to do quarterly meetings and I want, I want you to look at my entity structures and I want you to do this extra work for me and I'm willing to pay for it, a lot of them will say yes. It just depends on what their training level is too. So I know for myself and my partner in the firm, we've done a lot more training than is standard for the CPA license, just because it's something that we both have a passion for. So it is something that some offer, but I think most clients who approach me about it, after trying to work with their previous CPA, a lot of it's just mindset. If the CPA has just a reactive mindset, it's really hard to overcome that, even though they have, they might have the knowledge to do some of these things.
I didn't think there was anything on the CPA exam that taught you how to lower taxes for business owners.
No, there's nothing that teaches you, kind of the standard methods of reduction, but it's, it's the old joke, right? Who's the scariest, the murderer who's going to get away with it? It's the doctor, right? Because he knows how everything in the body works. And so he would know how to, make things go bad, right? And I think it's the same thing for tax professionals. We know how everything's going to flow onto the forms. We know how things are going to flow through the different brackets. And so, because if you know that, you say, okay, well, if we do this way, it'll flow this other way and you'll save, 10% or 5% or whatever it is. But a lot of them just don't kind of get to that second step of how do I really, back into some of these numbers.
And I think that's what my clients complain about. They're like, I went to my tax guy and he said, hey, someone told me I could do this. And they're like, yeah, you could do that. And they're like, well, why didn't you tell me I could do that?
Yes.
Why am I hearing it over a beer from some other guy at a bar?
Yeah. And it's just the mindset thing. A lot of CPAs and a lot of tax professionals like, well, you don't pay me for that. You pay me to file your forms. That's, they're not salespeople. They're not looking to do more. And then I think the other part of it is, a lot of firms, they have a really high compliance load. They'll say yes to anybody that comes in the door. And then now you as a client are competing with 1,000 other people to get their attention, because there's just not a lot of tax professionals out there anymore and our numbers are shrinking. And so I think all of those factors combined is why a lot of people are getting tax advice over beers from other, business owner friends, or, trying to Google stuff on the internet themselves instead of getting this from their tax pro.
I think the other thing is I don't think they understand the liability you have when you sign a tax return.
Yes. Yep. Yeah. And then when we give tax advice, it's, we have a fiduciary responsibility. And so it's a big thing for a CPA to stick their neck out and say, okay, we're going to try this thing, and especially with a lot of the more serious tax savings techniques. I'm very conservative in my practice, where if something hasn't made it through tax court, I'm not doing it. But you never know when you're going to get into hot water with the IRS over anything these days. So there is a lot of liability there.
So you said something interesting, until it's made it through tax court. So the IRS regulations themselves are essentially useless until they've been tested in tax court. So even though they say you can do this and do that, there's a lot of gray. Mm-hmm. And until you have a good defined answer from the tax court, which doesn't always happen. I mean, not everything gets through to that point, or it takes a long time to get to that point. There is a lot of gray.
Yeah, so there is a lot of gray area in the tax code, and it's one of those things that people don't really realize. It seems like taxes should just be black and white, but because the system in the U.S. really tries to be fair, and it also administers a lot of social programs through it, it just opens up a lot of gray area. And so for many different kinds of schemes that go on out there for trying to reduce taxes. There's a feedback delay from when people do things versus when it goes through tax court and when it actually gets tested. So that's why, at least in my practice, I'm very conservative with the kind of planning techniques we do, just because I always joke with my partner that I don't have the stomach for taking a client through tax court. So, there's a lot of things out there that I see other people do where I just know from what I've seen with court cases and then also what the guidance is that we have, that they just don't have a lot to stand on. And so, I wouldn't bet money on them that they're going to make it through tax court successfully. I've seen this a lot, especially with a lot of the things like conservation land easements. There's a lot of people that do that kind of work. And then also I've seen a lot of this more recently with the employee retention credit work that we do in the firm. I see what other practitioners are doing, especially a lot of ERC pop-up shops that aren't actually CPA firms. They take a lot of stances that I don't think there's, support for in the guidance, and that I would be very surprised if they make it through successfully if they do get inspected by the IRS. So it's one of those things where, I think you have to find a line between being the, extremely skittish, over-conservative tax professional that's not going to try to do anything versus, we do have techniques that have been through tax court, you have plenty of authoritative guidance to be able to do them. And they're very routine and normal versus people who are maybe going for these, kind of strung together, really aggressive stances, or, these kinds of transactions that don't really have they're jumping through a lot of entity structures, and they're jumping through a lot of these hoops to technically meet the requirement, but there's not really a substantial business purpose there. And so you're going to get inspected eventually. But there's that feedback delay, right? It can take years for the IRS to come back to this stuff. Because they have a certain amount of audit window. And then also if the numbers are big enough and the percentages are big enough, they can go back, 10 years, 20 years, depending on how much of a swing it is. So.
And at the end of the day, the client's the one who's going to get hammered.
Oh, yeah. And, most practitioners carry pretty good errors and omission insurance, but ultimately, it's the taxpayer's tax, right? And so if you're claiming a credit that you're not actually entitled to, you're going to have to give that money back. Or, if you're doing this scheme to get a really big charitable deduction that you're not, it doesn't pass muster, the tax practitioner is not going to be on the hook for that. You are. So I think a lot of people don't realize, the CPA is signing your tax return, but you're signing it too, and so you want to really make sure that person you're working with is serious and credentialed and, has good processes in place and has their head on straight.
And that's important. One of the areas this comes up a lot, I think, is subchapter S. And
yes,
what is reasonable compensation? And I see things all over the board. And sometimes I look at these, I'm like, that is not reasonable. That's crazy. Yeah. And the IRS is going to laugh you out of court in 2 seconds with that one. Any advice?
Yeah. So I think my main advice with that is I see people pick a number out of a hat, or they'll say, oh, we'll do 20% or we'll do 50% or we'll do something like that. That's not how the guidance is written, right? Reasonable compensation. There are a couple different ways you can determine it. There are a couple different ways that the IRS audits it. And so unless you're going to follow one of those prescribed methods, it's not a number you pick out of a hat. It's a number that has to be substantiated. And usually what I do with clients is I have an outside service provider that I work with where we do a full, employment survey, and it takes a look at how many hours are you spending doing different things, how much would market compensation be for those things that you're doing in the location that you're doing them in, right? It doesn't make sense to say a CEO of a company that's pulling in, a couple $1,000,000 a year is only getting paid $50,000 a year. Like, that's not going to, that's obviously not reasonable, right? But it just comes down to, how are you substantiating those numbers, and just picking a percent or picking a number out of a hat or picking a number that you like to try to reduce your self-employment tax. that's not a reasonable way to do that, right? Because that's not how you would compensate somebody off the street. So that's a common problem that I see people do. And it's a very legitimate technique to become an S corporation and pay yourself reasonable compensation. And it does reduce your self-employed tax. But, execution is 90% of the job there, making sure that it's done correctly.
And so the one thing that most people don't talk about with that is if you lower your Social Security payments, you get less money in the end.
Yes.
And so there is a
and it's
trade-off.
One of those things you have to triangulate for. If you start not paying into the system too much, you're going to reduce that benefit. And then if you start reducing your wages too much, it can impact other areas of your business as well. I see people do the same thing where they'll try to really drive their profit down as much as possible because they don't want to pay taxes. But then, next year when they want to go buy a new house or they want to get a new building for the company, they're not going to qualify for financing. So you have to take a kind of long-term perspective on what you're doing. And a lot of times, what I tell people is sometimes it makes sense to pay the tax, right? When you consider all things in the balance, it makes more sense to pay the tax.
And if they want to sell their business, it makes a big impact. And so there are ways to appropriately do this, but you need to take the time and have those conversations and not just wing it. Otherwise, you get stuck. And I will say this over and over again. It doesn't make sense to spend $1 to save 30 cents on tax.
Yes.
Just pay the tax, man. It's the penalty we pay for having a successful business. I pay a ton of taxes. I hate paying them. But at the end of the day, I'd rather keep my 70 cents.
Exactly.
And be able to go do something with that. And there are ways to do it appropriately. And so I think that's the conversation. How do we appropriately lower taxes? Mm-hmm. You've mentioned a lot about the employee retention credit. Can you just talk a little bit about who would qualify for something like this and what does it look like?
Yeah, so it's a COVID program, so it's not something that's ongoing. It's for tax years 2020 and 2021, and it's for people who have employees, so W-2 employees. Family members don't count towards it, and then also you can't double dip with PPP money that was forgiven with it. But a lot of people, there was a misunderstanding that if you got PPP, you weren't eligible for the employee retention credit, and that's not true. They changed the legislation, so most of the companies that I find, if they got PPP, more often than not, they do qualify for this credit. And just to give you some figures, I had a case a couple days ago where it's a pizzeria with 30 employees and they qualified for $200,000 of tax credits. So they can be really high impact. And usually what I recommend to people is if this hasn't been a very active conversation with your tax professional, that you should go back to them and make sure that you really are taking advantage of the program, just because it's such significant dollar amounts, if you are eligible for it. And the other piece I would recommend for people too to consider is that there are many different ways you can be eligible for it. So if you had a government shutdown order, or if you had quarterly revenue discrepancies, so you could even be more profitable year over year and still qualify for the credit. So unless you have somebody really examine your particular situation, I wouldn't trust when people just say, oh, I'm not eligible because I made more money, or, oh, I'm not eligible. I think my CPA looked at it and they told me I wasn't eligible. If you're missing out on like a $200,000 tax credit, I would urge you to be a little more diligent than just say, oh, well, I guess maybe not. Because it's can be one of the highest ROI activities you have related to your tax planning, for the next couple of years if you pursue this credit.
And I think people don't realize the tax code is very big.
Yes.
And nobody can be an expert at all of it.
Yes, very true.
And so depending on the type of CPA you're working with and what their focus is, they may or may not really understand this.
Yes. Yeah. And like my firm, like I said at the beginning, our specialty is really the tax planning work and then some of these specialty credits. And we do them a lot of the time for other CPA firms who don't have the specialty, because I think just the employee retention credit alone, it's over 200 pages of rules and regulations related to it. And it's a payroll tax credit, so it's not filed with your regular income tax returns. And so for a lot of CPAs who are just so swamped with just trying to meet regular compliance deadlines of, your tax returns, to try to take on a whole new credit program that's only available for 1 year or 2 years, that's a lot to ask for a lot of smaller practitioners. So that's why my firm partners with other CPA firms to do these for them and their clients, because it's kind of a monster of a program, but the benefit's there. We've been working on credits that have been, most people that we've been working with, it's been at least $50,000. Some of the bigger ones are at multi-million. So it's well worth really pursuing and making sure you do, vet that credit out.
What other types of credits or tax reductions should people be looking at?
I would say, the first place that you want to look, the first stage of tax planning is really being proactive about it and being in that mindset of, there's got to be things that I can do to reduce my tax, or this is something that I should pursue and try to figure out. The first stage is really entity selection and making sure that's really dialed in, because those are the big funnels of how the numbers are flowing, through the tax funnel and triggering the percent rates that you pay, right? Different entities pay different tax percentages. And then also how things are organized can make things flow through, the tax returns differently, and you'll be taxed differently on it. So that's the first piece that I recommend people take a look at. And it's something that you don't want to set and forget. If you started your company 20 years ago and you're operating out of a C corporation, that might not be the most efficient thing for you. Or, you started your company 6 years ago and you're operating out of an S corporation, might not be the most efficient way for you, because we've had a lot of big tax changes back during Trump's presidency. There were some really big changes with how entities are taxed. And so if it's something that you've just done a set it and forget it, it's something you want to reassess kind of regularly. So that's the first piece. And then the second piece really is those tax credits. They can be really powerful. And it's a lot of times once you've got the system set up to collect them and administer them, it's not a lot of extra work for you. And it helps in places, usually with like the payroll tax credits. For a lot of people, labor is the biggest number in their, in their P&L as far as expenses go. And so if you can get some extra help with taking advantage of payroll tax credits, there's a bunch of different programs out there that are great for those. You want to just take the time to make sure that you really are taking advantage of things, because a lot of times once you do the work once, you'll get it year over year, right? So it's worth pursuing.
Is there anything else we should have talked about today that we didn't get a chance to?
I feel like we've covered a lot of good topics. I know people's attention span for talking taxes isn't usually the longest, so I don't want to try your listeners' patience with going more into the weeds on some of these things. But
I think the important thing is have a conversation.
Yes.
Throughout the year, understand the ramifications of the choices you make. If you're yelling at your CPA because you have taxes due, they'll show you how not to pay taxes, but it will screw up your cash flow and it will screw up your profitability, because the easiest way to cut your taxes is to reduce your profitability. And that doesn't always make sense. And so you really have to be careful of how your conversations with your CPA are going. You want to maximize profits. And then once you maximize profits, what can we do to minimize taxes, but not at the expense of profits?
Yep, exactly.
If people would like to learn more about you, if they'd like to learn about the tax credits and how you help them, what's the best way for them to do that?
I'd recommend they visit our website. We've got a lot of resources on there. And for those who are interested in this sort of thing, there are plenty of videos of me talking about different credits and how they work and who's eligible for them in ways that are friendly to business owners. So I have a lot of that kind of information up on our website. And then if you're interested in getting assessed for these because your tax professional doesn't do them or doesn't want to do them, it's something my firm does for other CPA firms and their clients as well. So always happy to do an assessment for people.
And people are always going to ask, how much is an assessment?
It's complimentary for us. So we do kind of an initial pre-qualification through the website. And if you seem like you're going to be qualified, I have the mindset of I want people to know the full ROI of the work that I'm doing before they sign my engagement letter. So we like to let people know what their rough credit amount is going to be, just so that they can make the decision fully informed. So.
And I wanted people to know that, because otherwise they're like, oh, how much is this going to cost? Is it worth it? Hey, check it out, because at this point you're not paying up front to get an assessment to see if this is even something worth pursuing. And I think that's important. And a lot of tax work is done as a percentage basis. The specialty firms come in and say, hey, if we can save you X amount of money, does it make sense to work with us? So don't be afraid to talk to your CPA. And if you don't understand what they say, well, ask again or find one that will talk to you in your language.
Yeah. And that's the big part of it. I feel like half of my job is education, right? And so if I can't translate these complex rules into something that a competent business owner can understand, there's a problem there.
Very big problem. Thank you so much for joining us today.
Yeah, thank you so much for having me. It was a pleasure.
Are you having tax planning conversations multiple times per year with your accountant? Do you have conversations when you're making large purchasing decisions? Sure, leasing may seem like a better deal, but did you calculate how it would change your depreciation deductions? There are numerous factors to consider, and that's why you need to have these meetings with a CPA who does tax planning. If your accountant's not doing a good job answering your questions, maybe it's time for someone new on your team. Don't forget to check into the COVID tax credits to see if they apply to you.
If you want a done-for-you service, you can hire us as your chief profitability officers. You have your own area of expertise, and maybe you want to spend more of your time doing what you love. We only work with a handful of clients, so they all get our full attention. We work with business owners who have or are growing to $500,000 to $5 million in revenue. You can use the scheduling link in the show notes to get on our calendar for a good fit conversation to see if we're the right people to support you and how we can help you.
Hey, it's Rocky. Don't forget to check out my other podcast, Richer Soul, where we talk about life beyond money and how to live that ultimate life and become a better leader in your company. As we close out, let's repeat the mantra. Revenue is vanity, profit is sanity, and cash is king. Have an abundant and profitable week.